If you live in Japan and you are not using at least one of these two accounts, you are paying taxes. You do not have to pay. That is the blunt version of the situation. Japan has two primary, tax-advantaged investment vehicles, NISA and iDeCo, and understanding the real difference between them is one of the highest return financial decisions you can make as someone building wealth in this country. The choice is not complicated once you run the actual numbers. NISA stands for Nippon Individual Savings Account. The new NISA structure, which launched in January 2024, replaced the old system and made it significantly more powerful. Here is what you need to know. The new NISA has two components: a growth investment quota of 2.4 million yen per year, and an accumulation quota of 1.2 million yen per year. You can use both simultaneously, giving you a combined annual contribution limit of 3.6 million yen. The lifetime limit for the growth quota is 24 million yen, and for the accumulation quota it is 12 million yen, for a total lifetime cap of 36 million yen per person. Here is the critical detail. All investment gains inside a NISA account are completely tax-free. Permanently. Normally, investment gains in Japan are taxed at 20.315%. That is the combined income tax and resident tax rate on capital gains and dividends. Inside NISA, that rate drops to 0. And unlike the old system, the new NISA accounts do not expire after 5 years. The tax exemption lasts forever as long as the account exists. If you invest 10 million yen inside NISA and it doubles to 20 million yen over 20 years, you pay zero tax on that 10 million yen gain. In a standard taxable account, that same gain would cost you 2.0315 million yen in tax. That is real money. Now let us talk about iDeCo. iDeCo stands for Individual Type Defined Contribution Pension. It is a self-directed retirement account, and it works differently from NISA in 3 important ways. First, contributions to iDeCo are fully tax-deductible. Every yen you contribute reduces your taxable income for that year, generating an immediate tax saving. Second, investment gains inside the account grow tax-deferred until withdrawal. Third, withdrawals at retirement benefit from favorable tax treatment through the retirement income deduction, which is one of the largest deductions available in the Japanese tax code. But here is where iDeCo gets complicated. The contribution limits vary significantly depending on your employment type. If you are a company employee with no corporate pension, you can contribute up to 23,000 yen per month, which is 276,000 yen per year. If your company has a corporate defined benefit pension, your limit drops to 12,000 yen per month. If you are self-employed with no employee pension, you can contribute up to 68,000 yen per month, which is 816,000 yen per year. That is a dramatic difference depending on your employment situation, and it is the number you need to look up before making any decision. Let me run the numbers on the immediate tax savings, because this is where iDeCo gets genuinely compelling. For people in higher tax brackets, take a company employee without a corporate pension contributing the maximum 23,000 yen per month to iDeCo. That is 276,000 yen per year in contributions. If that person is in the 20% income tax bracket and pays 10% resident tax, their combined marginal tax rate is roughly 30%. The deduction saves them 276,000 multiplied by 0.30, which is 82,800 yen per year in immediate tax savings. Over 20 years of contributions, that is 1.656 million yen in tax savings from the deduction alone, before counting any investment returns whatsoever. For a self-employed person contributing the 68,000 yen monthly maximum, the numbers become striking. At 816,000 yen per year in contributions and a 30% marginal rate, the annual tax saving is 244,800 yen. Over 20 years, that is 4.896 million yen in tax savings from the deduction alone. Those savings are realized immediately in the year of contribution, not at some hypothetical retirement date. Now here is the question worth asking. Does that mean iDeCo always beats NISA? Not automatically. iDeCo has two significant constraints that NISA does not. First, you cannot touch the money until age 60. It is locked up completely. If you need liquidity for a house purchase, an emergency, or a business opportunity, that money is simply not available to you. NISA has no such restriction. You can withdraw from a NISA account at any time without penalty or any tax consequence. Second, iDeCo withdrawals at retirement are taxable, even though they benefit from the retirement income deduction. If your total retirement assets are large enough, some portion of your iDeCo withdrawal will be subject to income tax. NISA withdrawals are always tax-free regardless of size. So how should you actually think about the choice? Here is a practical framework. If you are in a high-income tax bracket, specifically if your marginal rate including resident tax is 33% or higher, the front-loaded tax deduction from iDeCo is extremely powerful. A person paying 33% marginal tax saves 330 yen for every 1,000 yen contributed to iDeCo immediately. That is a guaranteed 33% return before your investments earn a single yen. It is hard to find an alternative investment with a better guaranteed first-year return than that. If you are in a lower tax bracket, or if you value liquidity over maximum tax efficiency, NISA is the cleaner choice. The 0% tax on all gains, with no withdrawal restrictions and no contribution lockup, makes it the more flexible vehicle for people who might need their capital before retirement. The optimal approach for most people with meaningful income is to max out iDeCo first for the deduction, then use NISA for the remainder. These accounts work in parallel in the tax benefits stack. The government has made both accounts genuinely attractive simultaneously, which is unusual enough to be worth taking full advantage of. One more detail worth knowing. The new NISA contribution limits of 3.6 million yen per year are dramatically higher than the old system allowed. The old NISA maxed out at 1.2 million yen per year for the general account and just 400,000 yen for the old accumulation account. The new growth limit is 3 times higher. For anyone who was waiting to invest under the old rules, the new system is meaningfully more powerful, and contributions that are used and then withdrawn can actually be recycled in future years because the lifetime limit is restored when you sell a position. The old system never allowed this. You can take profits, reinvest in a new position, and retain your lifetime quota intact. Here is the actionable takeaway. If you have not opened a NISA account in Japan, open one this week. The process is straightforward through any major securities broker. SBI Securities, Rakuten Securities, and Matsui are the most popular choices for their combination of low fees and accessible interfaces. Set up an automatic monthly contribution to a low-cost index fund tracking either the MSCI All-Country World Index or the S&P 500, both available in Japan with annual expense ratios well under 0.2%. Then separately, calculate your iDeCo contribution limit based on your employment type and your marginal tax rate. If the deduction is meaningful to you, and for most full-time employees it genuinely is, open an iDeCo account and contribute the maximum allowed. The two accounts together give you a powerful, tax-optimized investment structure that most people in Japan are not using anywhere near its full potential. Tax-advantaged accounts compound faster than taxable ones. That is not a subtle difference over long time horizons. Run the math on 20 years of compounding at 7% without 20.315% tax drag on gains, and the difference is the equivalent of multiple years of contributions in additional final wealth. This is one of the few areas of personal finance where the right choice is also the mathematically obvious choice. If you found this breakdown useful, subscribe to Money Hack Japan. We cover Japanese investing, tax strategy, and market analysis in plain English for people who want to understand the real mechanics. More videos coming every week. The combination of NISA and iDeCo gives investors in Japan two complementary tools that work better together than either does alone. NISA handles flexibility and permanent tax-free gains at scale. iDeCo delivers front-loaded deductions that are particularly powerful for high earners. Fill both with low-cost index funds and let compounding do the rest. Subscribe to Money Hack Japan for more practical analysis on building wealth in Japan.